Have you ever wondered what ancient Chinese seafaring merchants and the stock market have in common? We thought you'd never ask. In the 3rd millennium BC, Chinese merchants laid the foundations for how most good investment companies approach the markets today. You see, most of the world's traders at that time would try and build ships that were the perfect balance between speed and strength. Speed made sure you got to sell your wares first, but strength made sure you got to sell them at all. Then they'd strap down their precious cargo and head out to face all of the dangers that the weather and the ocean could throw at them. They relied on their seafaring knowledge, navigational skills, ability to adapt, or even just pure luck to get them to their destination. Sadly, sometimes, it just wasn't enough. If a ship sank, it would sink the merchants, financially too. The Chinese merchants had a different approach. Understanding that they faced the same oceans with the same risks that the rest of the world did, they minimized their risk by dividing their cargo amongst themselves. This way, if one of their ships sank, they never lost all of their cargo. They had minimized their risk by not putting all their cargo in one ship. This is the same for investments too. One of the most important considerations when constructing an investment portfolio is how much return investors could expect for the extent of risk they are willing to take. Let's say that an investor has identified 30 stocks with a similar expected return. Research has shown that although the return on the stocks may be similar, the volatility or risk of a 30-stock portfolio would be far lower than a portfolio of only one investment. In fact, in many cases, the 30-stock portfolio would be less volatile than even the least volatile share invested in. That's why diversifying across local and offshore asset classes, such as equities, bonds, property, and cash, is as important. So while many people believe that investing can be risky, it doesn't have to be. With this in mind, we construct well-diversified investment portfolios that aim to deliver optimal returns for the overall risk of the portfolio. And even though there might still be some volatility, diversification significantly reduces your risk of losing your well-earned savings, which makes for a much smoother investment journey. This means that although you won't find your thrills in the stock market, you can find them somewhere else once you've reached your investment goals. So be a Chinese seafaring merchant and stay invested in a well-diversified portfolio.